We live? Yes, we're live. All right, hey y'all, it's Mike, Pro House Seller here, back with another video, man. I hope y'all are enjoying this beautiful weather on this Friday afternoon. I most certainly am not because, my Sixers lost in the second round once again. Once again, man, I will never see this team make it past the second round, man. But anywho, we're here with another video. We're talking about mortgages today. So I want to talk about this CNBC article that dropped the other day by Diana Olick. She explains her key points in the article. Talk about the rise in mortgage applications and the rise in adjustable rate mortgage applications. And I want to give my 2 cents on what I think that could mean for the housing market and overall the economy as a whole. So right now, in my last video, I did mention that mortgage applications are starting to slow down in terms of the rate. So mortgage applications overall, week over week, are up 5%. They're up 5% versus where they were last week. With that being in those increases in the mortgages, a lot of those mortgages that we're seeing now are adjustable rate mortgages as opposed to fixed rate mortgages. So I know what you're thinking, Mike, what's the difference? So with fixed rate mortgages, that's why I'm here. The fixed rate mortgages are typically the 30-year ones. So there's 15 years and there's 10 years ones. But usually when you hear whether it's a reporter, a realtor, or a broker, anybody talking about mortgages, they're usually talking about the 30-year fixed rate. That's the average one. And right now, the average 30-year fixed rate mortgage is hovering at about 5.5. I was looking on some sites before making this video. Some had theirs a little higher, some were at 6, some were a little under, but the national average right now is 5.5 versus in the beginning of the year, maybe it was 3-4%. So mortgage rates are rising fast. So that's why people are going towards the adjustable rate mortgage. So with the fixed rate, like I said, your rate stays the same. It doesn't change. So it's 5.5%. It's going to be 5.5% 10 years from now, 20 years from now, until you pay off your loan. So you're going to be paying 5.5. And that's getting expensive for people because within the last couple of years, rates were at all-time lows. People were getting in for 2, 3, maybe 4%. Now nobody's getting in under 5. So it's expensive. Your mortgage payment is expensive to live in the same neighborhood as somebody that bought within the last couple of years. Is it fair? No, but that's the situation. So that's causing buyers to go towards adjustable rate mortgages, and those mortgages are mortgages that reset after a certain amount of time. So the 30-year never changes, but the adjustable rate changes, whether it's 3 years, 5 years, 7 years, or 10 years. The average rate, the average starting teaser rate on a 5-year ARM, adjustable rate mortgage, is up 4.5% right now. Some banks are a little higher, some banks are a little lower, but 4.5% is the starting teaser rate for an adjustable rate mortgage right now. So that's a whole percentage point that buyers are saving. And when they're looking at that, whether it's brokers enticing them or encouraging to do it, or buyers just coming to that sense on their own saying, hey, if I want this house, I have to do this, they're going towards the adjustable rate mortgage anyways. So I've seen some agents talk about this, and the usual consensus in terms of an adjustable rate mortgage is that it's always bad. I won't necessarily say it's bad, because if you had an adjustable rate mortgage from like 2010 up until last year, you got a good deal. Rates were always going down and your mortgage payment was going lower and lower and lower every year, but you were still gaining equity because home values were going up. So that's not necessarily a bad thing if you get an adjustable rate mortgage in and of itself. The thing that makes an adjustable rate mortgage necessarily good or bad is more so your individual factors in terms of how long you plan to stay in there. The economic factors, which are different now and where we are now versus where they were a decade ago. Because like I said, if you got an adjustable rate mortgage a decade ago up until 2020, 2019-ish, you got a good deal. Rates were dropping and your mortgage rate was dropping every single time it reset. But now in today's day and age, when you're getting an adjustable rate mortgage, rates are rising. So yeah, maybe you're at 4.5% right now, but in 3 years, 5 years, if rates continue to rise, which with the inflation being so high right now, nobody necessarily sees rates stopping to rise right now unless we see a massive recession. your mortgage payment could be 5% at an AR at an arm, or 7% or 8%, within the next 3 5 years, and that doesn't even include the people that got arms in the past. They had a good deal now, but if they're continuing to stay, maybe uh, maybe they'll have a higher mortgage payment in the future. And I know some people might be asking, well, hey, Mike, what, they can just refinance, right? That is true. Just because you have a 30-year or a 5-year arm doesn't mean you always have to have the 5-year arm, and people are refinancing. But also in this article, which is kind of the catch 22, which is why I wouldn't say it's bad to get an arm, but it's risky. And the reason it's risky is with the rates rising, when rates go up, home prices tend to come down. Because when the mortgage payment goes up, now the home price has to come down to be able to kind of make that difference up. That's just typical supply and demand. So if you get a two, three, if you get an arm right now today, and rates continue to rise, maybe there's somebody that's trying to be savvy and they want to get an arm right now to get that that low 4.5% rate. You may not be able to refinance in 5 years if you lose all your equity. Maybe you can't refinance, or if we go into a recession with rates rising, because when rates rise, it's not just individuals, it's also businesses that get affected by that. Because when rates are going up, businesses have to go borrow money from banks at higher rates as well. So when businesses are going to look for investors, those investors, when rates were super duper dirt cheap, maybe they only needed a 5% return to break even, or make it worth their while. And when rates are rising now, that's more expensive. Now I need a 7%, maybe I need an 8% return in order to make this investment into this company. So now people are going to be stingy with their money. And when people are stingy with their money, it's not moving, it's not traveling, the velocity slows down. That's what causes a recession. And housing might be one of the first places to feel it, because housing is one of the places the money went into right away when the stimulus packages were passed. So with that being said, getting an adjustable rate mortgage today in this environment is very risky. I won't tell you not to do it, because there's situations where it does make sense, and I won't tell you to do it because there's also situations where it absolutely makes no sense at all. Me personally, I probably wouldn't get an adjustable rate mortgage right now, because if you're paying 4.5 today, even if you want to refinance, well, refinance applications are going down slightly week over week. According to the article, they're down 2%. And I'll drop the article in the description box, so you guys can take a look at that as well if you want to. But that's where we're at right now. So refinances are going down, with adjustable rate mortgages going up. In the beginning of the year, actually, with adjustable rate mortgages, there were 3% total. Of all the mortgage applications, there was three. Now it's 11%. So that's a significant jump in, and we're not even halfway through the year yet. We haven't even been through the second quarter yet. So with the inflation reports not being quite as good as we like them, adjustable rate mortgages rising, interest rates rising, refinance applications dropping, it's all a perfect storm for, I don't want to say disaster, but we're going in for a bumpy ride. So if you're going to get an adjustable rate mortgage, I would tell you to be very, very, very careful. Be very careful. Know what you're doing. Make sure your job is situated with. Make sure your business is situated with. Make sure you're going to be around and not get wiped out within the next couple of years, because everything is becoming risky for everyone right now. And I would hate for someone to get into a house right now at a 4% rate. 3 years, 5 years from now they're paying a 7% rate. That's double, and their income didn't double. So now you either got to make some sacrifices, or you're gonna have to let that house go because you can't afford it. So everyone tread carefully right now. This is a very unique situation we're in right now. A lot of uncertainty right now. So I will hit you guys with a new update, man. Appreciate you guys for watching. Like, comment, subscribe, and share this thing with your mom, your mom's mom, and your mom's realtor, and ask her why they're not using me as a realtor. But I will talk to y'all later.